Hello, everyone. Wall Street's bleeding. $42 billion dollars gone in a month. Treasuries dumped yields exploding past 5%. And while Washington scrambles to save face, China just pulled off a $5.3 billion IPO without a single U.S. investor. Now Besant's demanding a currency deal that could blow up global trade and crush the dollar on purpose. If this gamble fails, it won't just tank your portfolio, it could end America's control of the financial world. And it's already happening. You need to see what happens next. In 1985, Japan agreed to strengthen its currency at U.S. insistence. Within 24 months, the yen appreciated by over 50%, and Japanese exports collapsed. Cars electronics suddenly too expensive to sell. Export growth nosedived from 15% to 1.4%. That agreement, the Plaza Accord, wasn't a policy. It was an economic wrecking ball. And now in 2025, Washington is quietly preparing a repeat performance. But this time, it's targeting the entire global export engine, starting with South Korea, Japan, and China. At a recent finance summit in Saudi Arabia, Trump's economic advisor Scott Bessent laid it out. To rebalance the American economy, Washington is pursuing currency realignment, not through markets, but through policy pressure. The U.S. dollar already down over 3.2% this quarter, according to Bloomberg FX index data, is being weakened by design. In parallel, the Japanese yen and Korean won surged over 2% in just days following backdoor negotiations. But this isn't just about exchange rates. It's a strategic shift that could crush global exporters and trigger a wave of bond market instability. And the mechanism Bessent is proposing, it's not tariffs. It's something much more volatile. Besant's playbook is blunt. Weaken the dollar, force foreign currencies up, and watch U.S. manufacturing claw its way back through artificial pricing power. But the data presents a contradiction. According to IMF modeling reviewed by the Wall Street Journal, the U.S. is projected to lose 0.9% in GDP from current trade escalations, 50% more than China's estimated 0.6% decline. Labor costs in the U.S. remain 2 to 3 times higher than in developing economies, making organic competitiveness a long shot without intervention. So the U.S. is now pressuring allies to tilt the field through currency revaluation. It's not subtle. Bloomberg reports South Korea has already entered private discussions with Washington about exchange rate realignment. Meanwhile, Japan's still scarred from the aftermath of the Plaza Accord is resisting. Their central bank has refused rate hikes, fearing another export collapse. But here's the danger. If Bessent secures these deals, Asian exporters could lose pricing leverage just as U.S. manufacturing scales up with subsidies and reshoring incentives. The goal? To neutralize foreign price advantage, not by making U.S. goods better, but by making everyone else's more expensive. Toyota has already pledged $14 billion for a battery plant in North Carolina, but still plans to build over 3 million vehicles domestically in Japan. Why? Because the U.S. accounts for just 25% of its sales. That calculus changes dramatically if the yen strengthens 15% over 2 years, as it did post-Plaza. Export margins vanish. Global competitiveness erodes, and that $14 billion investment, it becomes a hedge. Not a Japan's Ministry of Economy has warned the U.S. not to repeat currency weaponization, citing the 1990s asset bubble that followed the last agreement. Korean tech and auto firms already facing semiconductor reshoring from the U.S. are now caught in a second front. Reuters reports that South Korea's won has appreciated sharply since April, more than 3.6%, year-to-date, creating unease among exporters dependent on dollar price contracts. Tokyo and Seoul are now demanding exemptions from U.S. tariffs in exchange for any currency adjustments. But Washington, under Bassan's advisement, appears unmoved. The message is clear: revalue your currency, or watch U.S. subsidies eat your global market share. But as negotiations stall, a different kind of pressure is mounting from the bond markets. Let's hit pause, because this isn't a trade war anymore. It's a currency war with collateral damage. On May 14th, the U.S. 10-year Treasury yield broke 4.5%, a critical level, not breached during the last tariff standoff. The 30-year is closing in on 5%. This isn't noise. It's distress. Bloomberg's bond market tracker now shows the widest spread between U.S. sovereign yields and German bunds since 2011. That divergence is directly tied to investor fears that Bassan's engineered dollar decline will trigger capital outflows from dollar-denominated assets. And it's already happening. UBS reports that private wealth clients in Asia have shifted over 14% of their portfolios away from U.S. bonds into gold and Chinese assets. The logic is simple. A weaker dollar devalues bond returns for foreign investors. If the dollar falls 6% in a year, a 5% yield isn't profit, it's a loss. Exporters sitting on $2.5 trillion in trade surplus from Taiwan to Thailand are reassessing U.S. assets in real time. And as they convert earnings to stronger local currencies, the demand for dollar bonds shrinks. The longer Bassan pursues a soft dollar policy, the more likely it becomes that foreign central banks start offloading treasuries, not out of protest, but out of necessity. But we haven't hit the most dangerous part yet. That's coming next. Scott Bessant told Congress there would be no gimmicks, no debt ceiling stunts, no shutdowns. The United States will never default, he said. Technically, that may be true. But the bond market is signaling something else: a default through devaluation. In the first quarter of 2025, the U.S. economy contracted by 0.3%. The Atlanta Fed's GDP Now model shows second quarter growth of just 2.3%. And that estimate is based on 7 days of data. Meanwhile, Trump's new tax plan, passed in March, adds $3.3 trillion to the debt by 2034, pushing the annual deficit to 7% of GDP, according to the Congressional Budget Office. That's not a rounding error. That's crisis-level fiscal drift, and the Treasury has no path to cover it except by issuing more bonds. But here's the problem. No one wants them. The 30-year yield is already over 5%. Investors are demanding higher returns just to hold U.S. paper. Bond issuance is up 17% year over year, while foreign demand has dropped by 12%. Bloomberg data shows. And even Bassan's proposed stablecoin-based demand bump, projected at $2 trillion over multiple years, would be outpaced by just 12 months of new issuance. The numbers don't match, and markets know it. Foreign buyers are already voting with their wallets. According to Bloomberg, EU-based investors lost 8.3% on U.S. Treasuries in the first quarter of 2025 when measured in euros, while Japanese funds lost over 6% due to currency depreciation. The dollar's 5.6% slide, year-to-date, against a basket of major currencies, has erased nominal returns on long-term debt. The Institute of International Finance reported a $42 billion outflow from U.S. fixed income assets in April alone, the largest monthly exodus since the of 2020. UBS confirms that its private clients in Asia have reduced U.S. bond exposure by 14%, reallocating heavily into gold, Chinese sovereigns, and crypto assets. The problem isn't just the falling dollar, it's the math. A 5% yield means nothing if the dollar drops 6%. And with the Treasury expected to issue another $1.2 trillion in debt by the fourth quarter. The pricing mismatch is only widening. But as yields rise to attract new buyers, something more dangerous is brewing beneath the surface. The last time U.S. debt crossed 100% of GDP, the Federal Reserve launched 3 rounds of quantitative easing to contain bond yields. Today, the Congressional Budget Office forecasts that by 2029, U.S. federal debt will hit 106.2% of GDP, its highest level in post-war history. Meanwhile, inflation remains stubborn. April CPI printed at 3.6%, up from 3.2% in March, driven by shelter and energy. If foreign demand continues to weaken, the Fed may be forced to intervene again, not for stimulus, but to stabilize debt markets. Former IMF economist Stephen Jen warned last week in the Financial Times that the U.S. is now one failed auction away from a bond market crisis. Restarting QE would suppress yields, but at a cost. The dollar would fall further, potentially triggering another round of capital flight. And if the Fed starts absorbing debt at scale, real returns for savers could vanish. The choice is binary: protect the bond market or defend the currency. Doing both may no longer be feasible. As Washington tries to prop up its debt, China is orchestrating its next financial triumph without U.S. capital. The electric vehicle giant KTL just raised its IPO target from $4 billion to $5.3 billion, according to the South China Morning Post, making it the largest offering of 2025 and nearly equal to the combined value of all U.S.-based IPOs this year. U.S. investors are locked out due to blacklisting and tightened SEC rules. Yet the IPO attracted heavyweight backers, including Sinopec and the Kuwait Investment Authority. KTL controls 38% of global EV battery production, with BYD adding another 14%. Combined, China supplies over half the world's EV batteries, despite new U.S. tariffs exceeding 100%. Reuters reports that global EV makers now face average input cost inflation of 30–40% on batteries if they bypass Chinese suppliers. China is ring-fencing capital and supply chains, simultaneously enabling firms like CATL to bypass Western markets entirely. Beijing no longer needs Wall Street to scale its champions, and the capital inflow confirms it. Global equities have surged 11% year-to-date, led by Asia, while the S&P 500 remains flat despite earnings beats from Apple and Microsoft. Morgan Stanley analysts noted last week that U.S. markets are no longer setting the tempo, they're reacting to it. In 2024, U.S. firms accounted for 54% of global IPO proceeds. So far, in 2025, that figure is just 18%, with Hong Kong and Singapore absorbing the majority. The World Bank reports that capital formation in China rose 6.9% in Q1 compared to just 1.4% in the U.S. Meanwhile, the dollar's decline has caused U.S.-based funds to underperform globally for the 4th straight month, according to BlackRock's international ETF tracker. And the exit is quiet but clear. Foreign central banks have reduced their holdings of U.S. securities by $327 billion since January, per Treasury TIC data. As the yuan rises and the dollar weakens, investors aren't just shifting capital, they're shifting allegiance. And that pivot may prove irreversible if Washington doesn't stabilize its macroeconomic trajectory soon. If Besson succeeds in forcing a global currency reset, it could give U.S. exporters breathing room, but it may also destroy the very foundation of American financial leadership. Foreign investors are already pulling out. The dollar's status as the world's reserve currency is being tested by capital markets not diplomats. And while Wall Street stalls, China's financial centers are accelerating, drawing in capital listing giants and funding the next wave of global tech. So here's the real question. If the U.S. has to choose between defending its debt and defending its dollar, what does it sacrifice first? And what if both are already slipping away? Rome didn't collapse when it lost its army. It collapsed when it lost the trust of its bankers. Let me know in the comments. Would you trust your money to the Fed's next round of QE, or are you already looking abroad? We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen. Goodbye, and see you again in the next programs.